Welcome to another episode of TP Talk, PwC's global transfer pricing podcast series, where we discuss key transfer pricing developments from around the world. My name is Kristina Novak, and I'm a principal in PwC's U.S. National Tax Services transfer pricing practice. In today's episode, we will discuss the complex world of stock-based compensation, or what we may refer to as SBC throughout this podcast. In particular, we'll examine SBC not only from a transfer pricing lens, but also its tax and accounting implications. Now, before I get started, let me introduce today's guest speakers. My first guest is Jennifer George. Jennifer is a principal in PwC's workforce transformation practice, and she has been involved with stock-based compensation work for over 20 years. She's based in San Francisco. My second guest, also from the West Coast, is Matt Haag. Matt is a transfer pricing and global trade principal in our Silicon Valley office with over 17 years of experience. Jennifer and Matt, thank you both for taking the time to join me today.
Thank you for having us, Kristina.
It's great to be here.
Wonderful. Now, before we dive into our topic for today, I know you both have recently traveled. Can you share some highlights?
Well, last year we did take one big trip to the Middle East, and the highlight of which was spending 5 days in an overwater bungalow in the Maldives. And beside being heaven on earth, it was just took the life out of us to get there.
I bet. And Jennifer, how about you?
Well, so last year I got to skip Thanksgiving. Everybody who knows me knows I do not like to make a turkey. It never tastes good. And my oldest child spent his first semester in college in Rome, Italy. We all went over there for Thanksgiving and skipped the dry turkey. We had pasta and lots of wine, and I think I'll do that every year.
It's a fantastic idea. And then for me, I just got back from hiking in Patagonia. We hiked the W Trek, which is on the Chilean side, hiked about 46 miles over 5 days, staying in garden domes and hostels, and it was absolutely gorgeous, a lot of fun. So let's go ahead and get started. So as I mentioned, the SBC world is incredibly complex. And to kick off this discussion, I think it makes sense to start with a broad overview of SBC, the typical fact pattern that we see, and then talking about this through the different worlds or lenses through which SBC issues arise. And we have three. We have the tax world, we have the financial accounting world, and we have the transfer pricing world. And part of the complexity in this space arises because, as you'll hear, the SBC rules in these three different worlds are not consistent. So Jennifer, I'm going to start with you to kick off this discussion. Can you give our listeners an overview?
Absolutely. So first, let's level set as to the normal corporate structure that we see. We usually see a parent company with subsidiaries around the world. As our companies are global earlier on, this is the typical structure usually from the beginning. And it could be a US parent, that's our most typical that we deal with in the US, but it could be a foreign parent as well. So the parent company offers shares of stock to employees through a stock plan. And they don't offer the stock plan just to their employees of the parent company. They offer this stock to their foreign entities as well. And it could be stock options, it could be restricted stock units, stock appreciation rights, whatever. It doesn't matter. For this presentation, we're just all going to call that share-based compensation. And although companies vary greatly, I think it's safe to say that all of our clients want to pay less taxes. So if we're talking about our normal corporate structure, US parent company at the top, grants equity incentives to employees around the world, in the US, we only get a US corporate tax deduction for awards that we are offering to service providers that provide services to a US entity. So for all the grants that are made to employees of the foreign subsidiaries, we're not getting a US corporate tax deduction for those awards. So then comes the question, is there any way to get local corporate tax deductions for the cost of these awards? And as we'll get into later, every country is different, but that is why companies want to think about if they do certain things, can they secure a local tax deduction for the share-based compensation? In most of these countries, if a local tax deduction is available, you have to do something that we call recharge. You have to recharge the cost of awards down. So, and recharge is just a fancy term, meaning that we put an agreement in place whereby the local foreign entity is legally obligated to pay the parent company for the cost of the awards. So that's what we're going to call recharge. It's not rocket science. It's just an agreement where the local subsidiary agrees to pay for the cost of the awards. Now, understanding and managing the interplay between recharge and inclusion of share-based compensation and transfer pricing calculations is imperative in trying to reduce the overall effective global tax rate. Because if you're just pushing income around to the foreign country and then to the parent company, then you might not be getting a tax deduction. But if you're just doing one part of that and pushing income into the foreign entity but not securing a local tax deduction, then that could be a tax inefficiency.
Jennifer, I had a question. Is a recharge really just a way that takes stock compensation, which is equity comp, and converting it into a cash charge for the local entity?
Well, that's a great question, Matt. And I wouldn't really call it a cash charge, but essentially it's cash, right? So, and the mechanics of a recharge, and we'll talk about the timing of the recharge of payment and the amount, but let's go through an easy example. If it's a stock option, US parent company has granted that to employees in, say, Ireland. Ireland is a foreign subsidiary. And then when somebody in Ireland exercises a stock option, usually what we call the cost is the spread and exercise, and we require the foreign subsidiary in Ireland to basically pay us a cash payment. And the fiction from a corporate tax standpoint is that we have a capital contribution from the US parent company down to the Irish subsidiary if we don't recharge. That's just a capital contribution down. If we recharge, then the Irish entity has to pay that cost. So this podcast is focused on discussing the interaction between transfer pricing, accounting, and local corporate tax deductions for share-based compensation. I'm going to give you a spoiler alert. There are no easy answers here.
And that's very true. Jennifer, why don't you dig into what makes this topic both challenging and very interesting? Can you cover the first two worlds, our tax world and our accounting world?
Absolutely. So over in the share-based compensation tax world, which is where I spend a lot of time and focus. So in the tax world, when employees get shares is usually when the taxable event occurs. So for stock options, it's when employees exercise options and get the shares. For restricted stock units, it's when we give them the shares. And that holds true not just in the US, but in the vast majority of countries outside the US. And then for our US corporate tax deductions, our deduction generally aligns with an employee's pay tax. So you pay tax on this, the employee pays tax on the spread of exercise, company gets a corporate tax deduction at that same time in the same amount. The IRS likes the employee income inclusion to line up with when we're claiming our corporate tax deduction. That's also true in most countries, and we'll get into some country specifics later, but that's true in most countries. So, and then if we set up recharge agreements, we're having the foreign subsidiary reimburse us for the cost. The amount of the recharge agreement, since a recharge agreement is just a contract between the parent and the sub, it really could agree to any terms. You could say, hey, foreign subsidiary, pay us $1 million every time somebody with a purple shirt exercises an option, just a contractual term. So, but most companies will take the recharge agreement and they will limit the amount to be recharged to the amount that's protected under Internal Revenue Code 1032. And that amount is the fair market value of shares at the time we issue them to employees, less any price employees pay for the shares. And that 1032 protection is important because then any amount that we get from the foreign subsidiary that's paid to the US parent company, that is protected as not being a taxable dividend to the US parent company. So the vast majority of the time when you set up a recharge agreement for share-based compensation, there'll be a limit on the amount recharged to this amount that's protected under 1032. So that's over in the tax world. Over in the accounting world, we have vastly different rules. So for GAAP and IFRS, we take an award that we've granted to an employee. We measure the expense at the time of grant. It's called the fair value of an award. And then we take that expense amount that's set at grant, and then we amortize it, meaning take in the expense and recognize it over the vesting period. In a simple time-based vesting award, it's easy to just spread that expense over a period of time. Unless there's some kind of modification or happens to the award, we never remeasure that expense. So the accounting cost is going to be very different than our tax cost. If the share price is going up, then the tax cost will always be more than our accounting amount. All right, and with that, Kristina, I think there's another world out there.
You're exactly right. There is one additional world. We've got our transfer pricing world. Matt, will you jump in and explain that for our listeners?
Sure. In transfer pricing, we deal with intercompany transactions. And the fundamental question that we're after here is whether stock-based compensation should be included as a cost for purposes of determining the pricing of these intercompany transactions. In order to answer that question, we really need to look at a lot of issues that Jennifer's already outlined. One is, does SBC appear in the local financial statements of the country in question? That's going to make a lot of difference into the visibility to the local tax authority of whether this cost is something that they're going to consider. That will depend on the accounting rules, the size and materiality of the country as to whether local financial accounts are going to be required. Are they going to be audited? Or are they just for purposes of determining the consolidated financials at the parent level? The next question is whether there's an actual charge or a notional charge. That could also depend on, as Jennifer mentioned earlier, whether there's a recharge agreement. I think it's also important to know whether or not they will get a tax deduction for stock comp, and what do you need to do to make that happen? And then it comes to the transfer pricing rules, whether you're required to reimburse the expense. A lot of tax authorities have the position that stock-based compensation is a cost, should be reimbursed, but is not deductible for local purposes. The issue there is that we could be creating what I call phantom income, which is we create income without an actual expense, or at least without a deductible expense, by reimbursing a non-deductible amount. And then finally, if we do include the SBC as a cost, one, do we include a markup? And two, how do we measure it? Jennifer mentioned we have a tax measure and we have a book measure that could be very different, both in terms of amount, but also in terms of timing.
Thank you, Matt. So as you can see, the tax and the accounting worlds, they don't agree on either the timing or the measurement of SBC. And in the transfer pricing world, at least outside of cost sharing, we don't have prescriptive rules on SBC. So it's not clear whether it should be included in the cost base. And if it is, what is the timing? How is it measured? Is it based on tax? Is it based on book? And these rules are all compounded by the fact that the rules, and particularly the tax and accounting rules, they aren't consistent country to country. And I think that's the other piece that makes this area so challenging. Jennifer, turning to you, can you provide some examples of differences in the treatment of SBC in different countries from both a tax and an accounting perspective?
Yeah, absolutely. So unfortunately, every country is a little bit different. The UK is the only country outside the US that does not require a recharge agreement to claim a local tax deduction. They do have some strange rules on the amount of the deduction, though, which are surprising. There are some countries, no matter what you do, you cannot get a corporate tax deduction for share-based compensation. A good example there is the Netherlands. Canada, it's really difficult to get. There are some countries where you can get a deduction if you do recharge, but recharge isn't allowed because of local exchange control restrictions, like China. As far as the accounting treatment under US GAAP and IFRS, regardless of whether the entity whose books it is making the grant or the parent company, an accounting expense has to appear on the local statutory books. There are some countries, though, where local book accounting is not required if the parent company is making the grants. So to Matt's point, some of these countries, there might not be kind of any cost recorded in the local books. And in some countries, you have to include it. So countries are all over the board as far as whether you have to include the share-based comp, whether you can get a corporate tax deduction for share-based compensation, and whether you have to include it in the local books.
Given that, is there a way for multinationals to synthesize their approach? In other words, can they have a one-size-fits-all approach?
Yeah, that would be really nice, but no. So companies really have to look at each country separately. I mean, honestly, there might be some countries where they're not making a lot of grants, so it might not make sense to go through the trouble of figuring out if they can get a corporate tax deduction and recharging. Because once you recharge, there's administration involved in that, right? So you have to send out an invoice, you have to figure out how to collect the payment, you have to keep track of it, then you have to make sure you claim your corporate tax deduction the right amount. So most of our companies, they basically do a country-specific kind of matrix, and sometimes we help them populate the tax, technical, and transfer pricing ramifications, and then they basically go down country by country and make a decision about what to do there, meaning whether to recharge, whether to include share-based compensation and transfer pricing, what should be the timing of the inclusion of the cost, and what should be the amount. And then set up a process to do the invoicing and the recharge. Also with the recharge, we've been primarily focused on the local tax deduction availability, but there are other things to think about in recharging. In some countries, like Brazil, if you start to recharge, you trigger an employee and employer social insurance contribution on the share-based compensation amounts. The employer portion is uncapped at about 32%. So most of our clients don't recharge in Brazil because they don't want to incur kind of the downstream effect on how that changes the local tax treatment of the share-based compensation. And there are some countries, like I mentioned, China, and there's other countries too, that have pretty stringent exchange controls that make it pretty difficult to recharge. So there's a lot to consider in whether to recharge and what your tax position should be in each country. Unfortunately, there's no one size fits all.
Thank you, that's helpful. Matt, I'm going to turn back to you. What are the other tax impacts or considerations that taxpayers should be aware of when analyzing SBC and their arrangements?
Sure. I first want to note that SBC is a significant issue, especially for companies here in Silicon Valley, because stock-based compensation is a large expense when it comes to compensation for these companies. We do note that stock comp is not only impacting the transfer pricing part of the provision, it also impacts other international tax provisions. I'm going to mention three right away. Those are BEAT, GILTI, and our Section 174 R&D capitalization amounts. First, turning to BEAT, remember we're talking about intercompany services, and in as much as you have a U.S. company making an outbound payment for services, those payments are subject to BEAT unless they meet some exceptions. Since the cost of those services can include a component of SBC, how you measure whether it is a cost and how you measure it impacts the amount of the payment. So therefore, it impacts your BEAT payments and the associated provisions. Second is GILTI. Again, we're talking about a cost or an expense which impacts income for your foreign subsidiaries. So whether you include this expense can impact the income and therefore your income for GILTI purposes. Finally, under Section 174, if certain activities qualify as a 174 expense, more research and experimental than, say, a 162 or other expense, then the SBC amount, if included, could also be amortized, whether it's 5 or 15 years, depending on the location of those activities. So that's another area where you have to watch out for SBC in your tax provision. Finally, I'll mention under 174, we have additional complexity, especially when you have cost-sharing arrangements because of the interaction between the 174 provisions and the stock comp issue and the stock comp provisions, especially since cost-sharing arrangements may choose to measure that stock comp either on the basis of the tax amount, or in some cases, companies elect to use the book amount. So you need to know both the tax and book amounts under that case.
Thanks, Matt. One thing I want to note, since you had mentioned Section 174, is that these rules are currently in flux. There is a House proposal that would restore current expensing for domestic R&D expenses while continuing the mandatory amortization over 15 years for foreign R&D expenses. But just note that the outcome of these rules could impact even further these SBC issues. So even apart from these rules impacting BEAT and impacting GILTI, let's turn to Pillar 2. This is our new global minimum tax regime. Matt, what can you tell our listeners regarding the interplay between recharge agreements and Pillar 2?
Sure. Pillar 2, of course, is something that's impacting basically all of our large multinational corporations. In the calculations of what's called the GLOBE or GLOBE income, you need to include an amount to measure SBC. The default rule is you use the book amount or the accounting amount, as Jennifer described, which is the fair market value of the charge at grant. However, the rules allow companies to make an election on a 5-year period on a jurisdiction by jurisdiction basis to instead use the tax deduction amount for measuring SBC when calculating your GLOBE income. So because of this election and the impact to your Pillar 2 calculations, it could have an impact to whether or not you would need a top-up tax in that jurisdiction. So it's important to understand the different measurement, the timing of the book and tax amounts, and to evaluate that on a jurisdiction by jurisdiction basis when performing your Pillar 2 calculations. So that's part of why we recommend everyone to understand these different rules and timing and run alternative scenarios if you foresee any issues when calculating your Pillar 2 income, your GLOBE income under Pillar 2.
So as you can see, these issues surrounding SBC, they're nuanced and they're complicated by the fact that these rules vary depending on what lens you're looking at them through, whether that's tax, accounting, transfer pricing, depending on the country that's involved. And before we sign off, I'd like to get your sort of final takeaways for our listeners. Jennifer, why don't you go first?
Well, unfortunately, the world is changing. So really taking a country by country approach and seeing what your strategy should be in that country. Unfortunately, as Kristina asked me, there's no one size fits all. Every country will be different. You'll have to have a different approach. And as this evolves and the risk evolves and every country's a little bit different, I think, as far as the risk analysis. So there are some countries that I think right now are pretty risky not to include the share-based compensation, the transfer pricing calculations, and other ones might not be so alert to the issue right now. But I think that every company really needs to take a hard look at their share-based compensation inclusions and if they're managing risk appropriately, and if there's any way to do share-based compensation in a more tax efficient manner and start doing recharge.
And I'll just add that stock-based compensation is a significant expense for many of our clients. There's lots of different policies and treatments that are being done by different companies, and it might depend on the country and by the intercompany transaction involved. We do note that certain tax authorities are pursuing stock-based compensation aggressively as an issue, and we know it's not desirable to have an outcome where phantom income is created.
Thank you, Jennifer and Matt. Those are all great points. And thank you for joining me today. I also want to thank our listeners for tuning in. We will be back next month with our next episode of TP Talk. Until then, have a great day.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.